the 1st of July 2017, the biggest changes to superannuation in a decade come into effect. The annual non-concessional contribution cap has been lowered. Non-concessional contributions are after-tax contributions. Before the changes, you could contribute $180,000 per year or $540,000 under the 3-year bring forward rule. Now, you can only contribute $100,000 per year or $300,000 under the 3-year bring forward rule. There are transitional rules, so if you need to contribute the full $540,000, you need to do that before 1st of July 2017. The annual concessional contribution cap has also been lowered. Concessional contributions are employer or personal contributions where a tax deduction has been claimed. Before the changes, the annual concessional contribution cap was $30,000 if you were under 49 on the 30th of June of the previous income year, and $35,000 if you were over 49. Now, the annual concessional contribution cap is $25,000 regardless of your age. The government has introduced catch-up concessional contributions. Before the changes, there was no ability to catch up on used contributions. Now, if you have an account balance of $500,000 or less, you can carry forward the balance of your unused concessional contribution cap for 5 years. Tax deductions for personal contributions. Before the changes, tax deductions for personal contributions were only available to people who earn less than 10% of their income from salary and wages. Now, if you are under 65 or between 65 and 74 and meet the work test, you will be able to claim a tax deduction for personal contributions to eligible superannuation funds up to the concessional contributions cap. Increased tax on contributions for those earning more than $250,000. Before the changes, you could earn $300,000 before an additional 15% tax was payable on superannuation contributions. Now, a tax of 30% is payable on contributions if you earn $250,000 or over. Transitional to retirement income streams. Before the changes, income attributable to transitional to retirement income streams were exempt from tax. Now, transitional to retirement income streams will no longer be eligible for exempt pension income. Earnings will be taxable at 15% instead of 0% previously. $1.6 million pension caps. Before the changes, there was no cap for pension balances. Now, there is a transfer balance cap of $1.6 million on the amount you can transfer into a tax-free pension account. If you have a pension that has a balance of over $1.6 million, you will need to move the excess amount back into accumulation or withdraw it from the fund prior to the 1st of July 2017. It is a transfer cap, so the pension assets will increase or decrease and the growth and subsequent earnings remain tax-free. breaching the cap will result in tax on the excess. If, because of the new legislation, you have to roll money back into accumulation mode or are in a TRIS, from the 1st of July 2017, any capital gains would become taxable, so the legislation has transitional CGT rules. The CGT relief arrangements allow you to reset the cost base on those assets. Basically, you pretend you sold the assets as of the 30th of June 2016. Now, there are no tax consequences on the pension proportion, but if the fund has some monies in accumulation, you need to make an election. You can either pay the tax now or defer it. But you have to make an election before the fund's 2016-2017 income tax return is lodged. If you defer the tax on the gain, you don't pay it until the asset is sold. Be super with your super. Be tactical with your super. Choose Tactical Super for your superannuation needs.